Hello, it's Wednesday the 12th. I'm FxPlew and this is the market brief. It's actually my mate's birthday as well, so happy birthday, Big Nose. Since the financial crisis in 2008, we've had an era of low inflation and low interest rates, and that's all over now. At the same time, the UK mortgage market evolved to the point that about 80% of mortgage loans were locked in on low rate, fixed rate deals. And that means that many borrowers have been insulated from the Bank of England rate hikes so far. But that's all coming to an end too. Estimates suggest about 1.6 million borrowers will need to remortgage before year end, and the higher interest rates mean that many monthly repayments will double, and in some extreme cases they may treble. The government has said that they will not provide any support on this, and so in the event that repayments become unaffordable, borrowers will have to sell. If this sees a big increase of housing stock on the market, prices will naturally drop, trying to drum up a bit of demand, and that could see negative equity return to the market for the first time in years. So with forecasts of a recession and a property market crash, things are shaping up nicely for a happy new year, aren't they? What a wonderful backdrop for a general election. That'll be an interesting one to watch next year. Over in the US, we've got the Fed minutes and June inflation data due out today, with inflation data forecast to come down to 3.1%. Many feel the Fed may think again about resuming rate hikes at the next meeting. If they do hike, it wouldn't be the first time the Fed has surprised the markets by acting more hawkishly than expected. Don't forget, they walloped in a couple of 75 basis point rate hikes last year. That was when the Bank of England was still bumbling along with 25 basis points at each meeting. Rhetoric from the Fed suggests that we will see a 25 basis point rate hike, and that further rate hikes may be less frequent than we've seen so far. The Fed feel pretty confident about that path because the economy has performed better than expected over the first half of the year. That was supported by a positive revision to Q1 GDP, and of course new job creation remains strong. Nevertheless, the market feels the Fed is coming to an end of the rate tightening cycle, and where the Bank of England and the ECB remain committed to raising rates further, the expected rate differential is rather dampening dollar demand at the moment. The dollar index continued its retreat yesterday, closing around 101.65. Sterling continued its recent rally, breaking 129.50 against the dollar. We open around 129.65 against the dollar. We're about 117.50 against the euro, and euro dollar is up at 110.30 this morning. Right, that's it from me. Have a great day.
If you do not have a clue, then just tweet through and ask FxPlew.